Hello, the lecture is on the Great Recession of 2007 to 2009. A major economic story of the 21st century was the Great Recession of 2007 to 2009. It started with an epic housing boom. In the first 5 years of this new century, the median price of American single family homes increased by more than 50%. Inflated house prices and increased household debt led to economic disaster for many homeowners and, in the long term, the nation. Economist Thomas Sowell writes that, quote, "Few markets have had such a skyrocketing rise, followed immediately by an equally steep plummet to new depths as the housing market has had in the early years of the 21st century." Sowell's book, The Housing Boom and Bust, offers a clear picture of how the housing boom began, propelled by questionable government policies, and how an economic reckoning was inevitable. Home ownership is a major step for people. A person's home is usually their largest financial asset, but also their greatest financial liability. The biggest portion of a debt for a homeowner is mortgage debt. With few exceptions, people do not buy houses with cash. They need to borrow, and interest rates make a huge difference with home buying. When there are low interest rates, there is a rise in demand for houses, which drives up house prices. The interest rate can vary according to a person's financial condition and credit record. People denied loans at prevailing interest rates could qualify for subprime loans, which had a higher interest rate. Subprime loans took place without any adequate attention to the long statistical track record of new home owners. Financial institutions need that higher interest rate to offset the possibility of a homeowner defaulting. Many first-time homeowners needed assistance, of course. They faced the challenge of having the necessary cash for a down payment that often was in the range of 20% of the home price. Lenders recognized this obstacle for first-time buyers, but it was a matter of balancing profits and the possibility of defaults. Housing prices throughout America varied widely. In the 2000 to 2005 period, the median home price in New York jumped 79%, and Los Angeles saw a 110% rise. Indeed, coastal California cities saw major rises. In the San Francisco Bay Area, homes cost 3 times the price of the national average. The cost of building a home in any region of America was similar. The cost of lumber and building supplies did not vary much. The difference was the price of land. A quarter-acre lot in Chicago was approximately $140,000, whereas the cost of a quarter-acre lot in San Francisco was close to $700,000. The regions that had skyrocketing housing prices had adopted laws and policies that restricted the use of land. For example, the artificial scarcity of a California county drove up house prices and modest-sized homes became million-dollar homes. In many cases, upscale homeowners welcome laws that stated homes must be built on lots no smaller than an acre or even several acres. Keeping the density low was a way for upscale communities to have a wider buffer zone. Environmentalists embraced land restrictions, even though less than 10% of the total land area of America had been developed. Growth management planning included zoning laws, building permit limits, height restrictions, and minimum lot size laws. Land restrictions were not uniform across the nation, and thus many Americans could find affordable housing. In his 2010 book on the housing boom and bust, Thomas Sowell wrote, "Today, a family in an American city without growth management planning can buy a very nice middle manager's home with about 2,200 square feet, 4 bedrooms, 2.5 baths, and a 2-car garage for $150,000 to $200,000. In cities then that had growth management planning for 10 to 15 years, that same home would cost $300,000 to $400,000. In cities that had the planning for 25 years or more, the same house costs from $500,000 to as much as $1.5 million. Even though there was affordable housing available in much of America, thus there was this misconception that, quote, the free market failed to produce affordable housing and that government intervention was therefore necessary in order to enable ordinary people to find a place to live that was within their means. Politicians acted as though there was a national housing problem. That is, there was a problem nationwide where people could not buy homes because of the boom, but this was not the case. The housing problem was only in particular areas. Even a 2005 New York Times report recognized the affordability of housing in most American regions. Quote, "Despite a widespread sense that real estate has never been more expensive, families in the vast majority of the country can still buy a house for a smaller share of their own income than they could have a generation ago. A sharp fall in mortgage rates since the early 1980s, a decline in mortgage fees, and a rise in incomes have more than made up for rising house prices in almost every place outside of New York, Washington, Miami, and along the coast in California." End of quote. The housing boom correlated with the rise of risky methods of home financing. Lax standards for mortgage loan applicants were politically attractive. There were good reasons to see more people owning homes, especially minorities and low-income consumers. Home ownership improves community stability. Turning a blind eye to the potential dire consequences of easier mortgages Washington politicians contributed to both the housing boom and bust. In the 1990s, President Bill Clinton supported action to get lower income people to buy homes. In 1999, the New York Times reported, quote, Fannie Mae, the nation's biggest underwriter of home mortgages, has been under increasing pressure from the Clinton administration to expand mortgage loans among low and moderate income people, and felt pressure from stockholders to maintain its phenomenal growth in profits. Fannie Mae was the name for the Federal National Mortgage Association. The Federal Home Loan Mortgage Corporation was called Freddie Mac. So we have Fannie Mae and Freddie Mac. Although both of these were government created, they were privately owned. Their business was making profits from buying mortgages from banks. Most of the strongest supporters for lower mortgage rate standards were Democrats, but there were also some Republicans who favored lax standards. President George W. Bush, who took office in January 2001, was supportive of this thinking. His administration urged Congress to pass the American Down Payment Act that gave assistance to low-income home buyers. Next, Congress passed legislation permitting the Federal Housing Administration to begin making zero down payment loans at low interest rates to low-income Americans. The Federal Housing Commissioner, John Wheeler, explained, quote, the White House doesn't think those who can afford the monthly payment but have been unable to save for a down payment should be deprived from owning a home, end of quote. There were warnings during the boom that creative financing could result in serious consequences, but there was no stopping the momentum of lower mortgage standards. In a May 2005 Wall Street Journal column, that is, economist Thomas Sowell warned that, quote, this whole financial arrangement can collapse like a house of cards. When the speculative bubble burst, the whole economy would be hit hard. Others had similar arguments. Scholar Peter Wallison, also in 2005, declared that if Congress failed to rein in Fannie Mae and Freddie Mac, quote, there will be a massive default with huge losses to the taxpayers and systematic effects on the economy. That was quite the prophecy. Federal Reserve Chairman Alan Greenspan testified to Congress of potential problems. After his term as chairman ended, he was even more vocal, but it was too late. One powerful supporter of easier mortgages was Democrat Congressman Barney Frank. In 2003, he dismissed the critics. On Fannie Mae and Fannie Mac, he declared, quote, I believe that we, as the federal government, have probably done too little rather than too much to push them to meet the goals of affordable housing and to set reasonable goals. Frank wanted Fannie Mae and Freddie Mac to get, quote, more deeply into helping low-income housing and possibly moving into something that is more explicitly a subsidy, end of quote. In 2003, Democrat Congresswoman Maxine Waters stated that there was no crisis at Freddie Mac. When President Bush expressed concern in 2004, Franks, Waters, Nancy Pelosi, and 73 other House Democrats sent Bush a letter stating that an exclusive focus on safety and soundness is likely to come in practice at the expense of affordable housing. Democrat Senator Christopher Dodd was another to dismiss warnings on the soundness of Fannie Mae and Freddie Mac. In 2006, there were many subprime borrowers only making a 5% down payment on a home. And there were the adjustable rate mortgages that had become popular. Thomas Sowell writes that the adjustable rate mortgages taken out when interest rates were unusually low brought monthly mortgage payments down below what they would be in a conventional 30-year fixed rate mortgage, thus enabling more people to stretch their incomes to cover the price of buying homes that they might otherwise be unable to afford. Put differently, these temporary arrangements concealed the fact that some people were buying homes that they would not be able to afford in the long run, end of quote. When it came to no down payment loans, homeowners only had to worry about paying the interest in the first 2 years. They were confident that their incomes would increase before the time of higher monthly payments to pay off the principal. Besides, with house prices rising, they were happy to gain home equity. In fact, other people were buying and flipping houses for a profit with the rising market. Some had multiple house deals. Such speculation was another factor in driving home prices even higher. There were several main players in the boom and bust episode. Borrowers, lenders, financial markets, and governments need to share the blame for what happened in the early 21st century. The Department of Housing and Urban Development, for example, had pressured mortgage bankers not to turn down a higher percentage of minority applicants than other applicants. As for the banks used by home buyers, they were connected to other institutions. The Federal Reserve System dealt with interest rates and money supply, for example. Low interest rates, of course, encourage home ownership. Two other important entities mentioned earlier were Fannie Mae and Freddie Mac. In selling mortgages to Fannie Mae and Freddie Mac, banks benefited by getting money from a long-term mortgage, such as a 30-year mortgage, without having to wait all those years for mortgage payments. Banks took the money from these sales and used it again for additional mortgages. This process was popular in 2004. More than 67% of mortgages were bought by Fannie Mae, Freddie Mac, and other similar financial institutions. One pressing issue of concern with the, quote, reselling of mortgages on a large scale is that the initial lender has fewer incentives to be meticulous about the financial qualifications of the people to whom mortgage loans are made. Another important point is the Fannie Mae and Freddie Mac is that they are government-sponsored enterprises, and thus other financial institutions will, quote, lend to these two hybrid institutions at lower interest rates than they would to completely private enterprises because of the implicit assumption that in the event of a crisis, the federal government would not let Fannie Mae and Freddie Mac fail. But Fannie Mae and Freddie Mac continued to do business without any serious oversight. Some politicians benefited nicely. Economist Gerald O'Driscoll argued that Fannie Mae and Freddie Mac were examples of crony capitalism. Claiming to serve the common good, politicians and business people made money from these mortgage giants. Politicians received campaign funds and contributions from their business friends. Driscoll stated that because government backing let Fannie and Freddie dominate the mortgage underwriting market, private sector criticism was silenced. Local banks that wanted to offer mortgages dared not speak out against them. Large banks dared not complain about the giants' government-given advantage because they needed to be able to buy securities from Fannie and Freddie. In 2006, trouble began. House prices fell in record amounts. There were many mortgage foreclosures. This trend continued in 2007 and 2008. Lenders repossessed homes and put them up for sale. The extra supply of houses on the market further caused prices to plummet. In 2008, the San Francisco Chronicle reported that half of the homes sold in the region were foreclosures unloaded by banks at fire sale prices. While areas such as coastal California were hard hit, other locations saw only modest change. Known for its fewer building restrictions, Dallas, Texas witnessed only a 3% decline in home prices. Homeowners caught with the riskier adjustable rate mortgages were in dire straits, unable to pay the higher monthly mortgage payment. The crisis of subprime loans became obvious. Many first-time homeowners were in distress emotionally and financially. Spectators found themselves unable to sell their multiple homes, rising interest rates even further. The financial disaster did not stop with the housing market. European investors suffered huge losses from their investments in securities based on the value of American home mortgages. With the economy going in recession, the politics of blame got ugly. There were economists pointing to misguided government policies as the main problem, but the politicians who were the architects of the lower mortgage lending standards fought back. The Senate Banking Committee, chaired by Senator Christopher Dodd, pointed the finger at Wall Street's greed, inadequate regulatory oversight, and he had the support of Senator Charles Schumer. Also in the House, we see that in the House, as in with the senators who continued to defend Fannie Mae and Freddie Mac, you have the House Financial Service Committee chaired by Congressman Barney Frank, who I mentioned earlier. He likewise blamed the lack of regulation. He thought there was actually not enough regulation. Other Democrat leaders were Senator Barbara Boxer, Senator Richard Durbin, Senator Harry Reid, and they all desired more government intervention. Now back to Senator Charles Schumer, he blamed the Bush administration. Quote, "These unprecedented events have made it clear to the country what many of us have been saying for a long time. We are in the midst of the greatest financial crisis since the Great Depression. After 8 years of deregulatory zeal by the Bush administration, an attitude of the market can do no wrong has led it down a short path to economic recession." Political interpretations and economic interpretations certainly did not coincide. They did not match. So economists like Thomas Sowell was stating something very different than the Washington politicians. So Sowell was clear where he thought the problem lay. He argued that the lax lending standards came not from a lack of government regulation and oversight, but precisely as a result of government regulation and oversight directed toward the politically popular goal of more home ownership through affordable housing, especially for low-income home buyers. In the end, the political interpretation gained more traction than economic interpretations offered by Sowell and others. In 2008, the government favored more intervention. Congress voted for massive stimulus packages. In the last years of the Bush administration, Congress approved $700 billion to revive the economy. President Barack Obama supported an additional $787 billion stimulus package. The hope was that the $1.4 trillion would stimulate other spending by businesses and consumers. Unfortunately, the results were less than encouraging. In October 2009, the jobless rate hit 10%, the highest in 25 years. Industrial production that followed was anemic. The economy continued to be weak for years. In the first 4 years of the so-called recovery, economic growth only averaged about 2%. The Great Recession of 2007 to 2009 had deep and long-term effects. Thank you.